Hello everyone, and welcome again to Nettle, the best platform around for distance learning in business, finance, economics, and much more. Please don't forget to subscribe to our channel and click that bell notification button below so that you never miss fresh videos and tutorials you might be interested in. Many thanks to our current Patreon supporters for making this video possible, and would also greatly appreciate if you consider supporting us as well, so please check the link in the description for more details. My name is Seva, and today we're going to investigate a very frequently neglected yet really important source of interest rate risk, that is, basis risk. We'll discuss the two main types of basis risk, how it emerges, how to measure it, and why is it relevant for systemically important financial institutions and big banks in general. To understand the issue in more detail, I can refer you to one of our earlier videos on interest rate risk management using internal and external hedging. And in particular, if you use external hedging to manage interest rate risk, that is, you negotiate and enter interest rate swap contracts to immunize your bank against either net interest income exposures, economic value of equity exposures, or if you carefully fine-tune the details of the swap contract against both, well, you can do that only if you can get a perfect hedge. If you can negotiate a swap contract where the underlying exactly matches the dynamics of the interest rate you're exposed to, what is the ultimate cause of your interest rate risk exposure. Sometimes you cannot negotiate for the perfect solution and you need to opt for imperfect hedges. And the two main sources of imperfect hedges arising on the market are the quality and timing basis risk. The quality basis risk arises when you can negotiate a swap contract for an interest rate of the same maturity, but when the interest rate is applicable to some other investment product or some other time series. So for example, if our bank, if our systemically important financial institution is exposed to a 90 days LIBOR rate, for example, it needs to pay out interest on some short-term lending provided on an interbank market, it might not be able to arrange a swap with the LIBOR rate as an underlying, and it could opt for something very close in terms of maturity and something very close in terms of currency, but again, slightly different in essence. For example, it might try and hedge its interest rate risk exposure by negotiating a swap for the 3-month yield on a US Treasury note. And from the first glance, it seems like a good deal. Both interest rates are of the same maturity, 3 months, well, 90 days is exactly 3 months if you use the actuarial date format. They are both in USD and they are both representing relatively risk-free lending that is available quite liquidly on the market. So no liquidity risk attached, very few default risk attached, same maturity, same currency. And even if you look at the graphs of the two interest rate dynamics from the start of 2006 until the end of 2020, you can see that the movements overall are matching quite well, with the blue line being the rate on US 3-month Treasury notes and the orange line being the 90-day LIBOR rate, both in US dollars, obviously. You can see that the dynamics match quite well, and there is a notable spread between the two, this spread being relatively stable, apart from some weird blips occurring over here most notably, and most recently around beginning of April 2020. So what went wrong here? Well, those peaks in the LIBOR rate with respect to the US Treasury note yield are instances when liquidity risk is prominent on the market for financial institutions, and interbank lending is at a premium, with banks valuing short-term or slightly medium-term liquidity, which 90-day lending is, and asking for a premium, asking for a higher interest rate on their interbank loans. And we can see that liquidity risk was pretty much an issue during the financial crisis in 2008. It yet was a similarly big issue at the beginning of the current crisis in April 2020, and we can see some minor peaks over here, which are not as pronounced but quite persistent as well, which can be attributable to the euro area sovereign debt crisis, when liquidity also was more valuable and liquidity risk contributed to the spread between the LIBOR rate and the US Treasury note rate being higher than usual. So let's calculate the spread between the two rates. So substituting the US Treasury note rate from the LIBOR rate and calculate it for the whole sample. And here we have got weekly yields and rates for both of our interest rate risk series from the beginning of 2006 until the end of 2020. And what we're concerned now is how well can you hedge the risk that arises for our bank that is exposed to interbank lending rate, and how well can it proxy it with an imperfectly correlated substitute, an imperfect hedge being the dynamics of the US 3-month Treasury note. After all, if you negotiate a swap where you receive the US 3-month Treasury note yield and pay fixed, you can, if the two are perfectly correlated, reduce your exposure to the LIBOR rate substantially. But how perfectly are they correlated and how much can you reduce the exposure is an open question. And to investigate it, we can calculate the yield differences week to week. So here we just subtract the yield last week from the yield this week and the interest rate LIBOR as well. And we also calculate the same difference in terms of the spread. So here, for example, in the first week, we can see that both rates moved in the same direction. The yield on the Treasury note increased and the yield of the 90-day LIBOR increased, but not nearly in the same magnitude, with the Treasury note yield increasing much more than the LIBOR rate, bringing the spread down a little bit from 0.43%, 43 basis points, to 37 basis points. And calculating the spread throughout, we can now determine, first of all, how tightly correlated are the changes in spread week by week for our two yield or interest rate benchmarks, so how imperfect this hedge is, and also we can compare the risks, the standard deviations basically, of those yield changes and the difference of those yields, because ultimately, overall, when you negotiate such a swap, you would effectively reduce your exposure to the difference in the spread growth across the LIBOR and the Treasury note. So let's do just that. Let's calculate our correlation of differences in yields or rates across 2006 and 2020. So to do that, we can use the correl function and figure out how tightly correlated the two yield changes are. And we can see that the correlation is positive, meaning that the two interest rates do indeed move in unison to some extent, but it is quite far away from one, quite far away from perfect correlation that you would desire in a hedge. And now we can actually see what does it mean for hedging in terms of reducing risk, in terms of reducing exposure. Let's calculate the sample standard deviation, stdev.s, of the 3-month Treasury note yield deviation, and we'll see that if we calculate it in basis points, so we multiply it by 100, we can see that on average the yield changes 12.78 basis points in either direction. If we look at LIBOR, the difference would be 8 basis points exactly, so the LIBOR rate would be quite a lot less volatile than the Treasury note on average. And if you look at the volatility of the hedged position, so the difference between the LIBOR rate and the Treasury note, the payoff that you would have received if you're exposed to the LIBOR rate in the first place, but then you negotiate a swap when you pay fixed and receive the Treasury note yield, well, the volatility of such a position would be 14.18 basis points per week. It means that if you hedge it using such an imperfect hedge, your weekly volatility would actually increase quite counterintuitively. And compared to the initial volatility that you would receive if you just stayed as you are and have not hedged your position with an imperfect hedge, actually your volatility, your risk, would be almost twice lower. Really counterintuitive, isn't it? Especially if you look at how closely the paths of two interest rate benchmarks match throughout the period. And here is what we learn if we also look at annualized standard deviation in basis points. To calculate it, we just need to multiply our weekly standard deviations by the square root of the number of weeks in a year, and everybody knows it's 52, so multiplying by the square root of 52. And here we can see that obviously the situation doesn't change really, with the standard deviation, the risk of the hedged position being much higher than the risk of the default position, with 90-day LIBOR being our sole exposure, and even higher than the other component of our hedge, the volatility of the US 3-month Treasury note. So what happens here mathematically? Why is it the case that hedging your exposure with an imperfect hedge, even when the correlation is positive, generates such an awkward result ultimately? Well, here we need to look at this formula that demonstrates how to calculate the variance of a difference of two random variables. And that's what we do in a hedge ultimately, as we have our final exposure being the difference between the initial position, here it is a 90 days LIBOR, and the hedge that we use, here it is the 3-month Treasury note yield. So our volatility in total, our variance in total to be precise, would be the sum of variances minus two correlations times the product of volatilities of those two series. And here, if we assume that the variances and the volatilities of the initial rate, the LIBOR rate, and the rate we use to hedge are roughly equal, which is not exactly the case here, but bear with me, that is just for mathematical simplicity, we can derive that our hedging position reduces volatility only if the correlation between our initial exposure, the true interest rate we want to hedge, and our imperfect hedge we use to reduce the risk, well, the decrease will be achieved, the hedge would be effective and productive only if such a correlation is higher than a half. And here we see that the correlation is indeed lower than a half by a lot, and that is what causes our hedged risk to be higher than our initial risk. And if we look at the dynamics throughout the years, we can see that in no single year from 2006 until 2020, such a hedge was productive in the first place, because the correlation is never that close to 1. The highest it is in 2019, when it is equal to 0.54, but even then, as the Treasury note volatility is quite a bit higher than the LIBOR volatility, our hedge is actually not productive, increasing our volatility by quite a lot. So it tells us how relevant the quality aspect of basis risk is, and how important it is to assess the correlation between the exposure you are currently having and the exposure you are trying to use to hedge this position away. Most of the time, if the correlation is not very close to 1, even if it's 0.54, it would be a statistically significant correlation in pretty much any estimation you undertake. Even in that case, this correlation is not high enough for hedging to be successful. And that leads us to our second case, where we investigate the timing aspect of basis risk. The timing aspect of basis risk arises when you can hedge your position with a very similar interest rate benchmark, but of a different maturity. And in our case, still assuming that our financial institution is exposed to a 90 days LIBOR, they could try and hedge their position within 180 days LIBOR. And obviously these two are again imperfect correlates, and 180-day LIBOR would be an imperfect hedge. But how imperfect? How imperfect being crucial actually, as we see from the past example. Well, to get some brief idea at first, we can look at the dynamics of the rates, and we can see that the episodes of liquidity risk quite well coincide in the two rates. only the most extreme cases of liquidity risk, short-term liquidity risk that is, in 2007-2008 financial crisis, here being October 2008, this peak of shorter term rate, 90-day LIBOR, not being matched by a respective peak of a longer term, 180-day LIBOR, and in April 2020, when the 90-day LIBOR jumps and 180-day LIBOR doesn't jump as much. However, the cases where we remember the LIBOR jumped and the Treasury note yield stayed the same, in the episodes attributable to the Euro area sovereign debt crisis, here we can see that the two LIBORs move in unison, and it is actually good news for us, as it would provide better hedging, potentially, at least looking at it qualitatively, for this particular period, if we consider this imperfect hedge and not the imperfect hedge based on quality. So now we just need to do exactly the same, calculate the spreads between the two LIBORs, and here we can see that here the spread is negative, and that's unsurprising, as longer term LIBOR generally would offer a higher rate due to liquidity risk, but that's not really what we are concerned with here. We're concerned with the degree of correlation between the changes in two yields, two interest rates. So here we can calculate just that, calculating the differences from week to week, and drag it across throughout our period that again begins in 2006 and ends November end 2020. And here we can still calculate our correlation between the yield changes of 180-day LIBOR and the 90-day LIBOR. And here we see that the correlation is much closer to 1. It's 0.92. And here we can again apply the same procedure, calculating the standard deviation of weekly yield in basis points, so multiplying by 100, converting percentage points to basis points. And here we can see that our 180-day LIBOR is a little bit less volatile than 90-day LIBOR. Well, it makes sense given that short-term liquidity can be more volatile in its price than longer-term liquidity, especially given these two episodes where shorter-term liquidity was at a premium and longer-term liquidity didn't change that much in its price, corresponding to 180-day LIBOR rate. And here we can also convert our weekly volatilities into annualized volatilities by just multiplying those by the square root of the number of weeks in a year. Here we can still see that our hedged position actually quite dramatically reduces our initial exposure. It reduces it more than 50%. In terms of weekly volatility, we reduce it from 8 basis points to 3 basis points. In terms of annualized exposure, we reduce it from 60 basis points to 24 basis points. Quite nice. And it is enforced by this simple formula where we see that our hedge is effective, is successful, particularly due to the fact that this correlation coefficient is much higher than 0.5 and is quite close to 1, meaning that even though this hedge is imperfect in terms of timing, in terms of maturity, it is still a good deal, especially compared to the previous hedge that was imperfect in terms of its quality. And if we look at the success of such hedges across time, we can see that almost always, except in 2013 and 2019, the hedging position would have been successful at reducing risk, and most of the time it would be quite materially successful, reducing risk substantially. And even in 2020, when the markets were quite volatile, both in terms of your regular stock markets, commodity markets, and the interest rate markets, interbank lending markets in particular, we can see that our hedged position reduces volatility by a half, just as it does on the whole sample. So here we see that this imperfect hedging scenario, where you opt for similar interest rate benchmark but of a different maturity, is more robust in terms of reducing your interest rate risk exposure compared to an imperfect hedge quality-wise. And that's all there is for basis risk in interest rate risk hedging. Please leave a like on this video if you found it helpful. In the comments below, I'm eager to see any further suggestions for videos in business, economics, or finance you would like me to record. And please don't forget to subscribe to our channel or consider supporting us on Patreon. Thank you very much, and stay tuned.